Hello again, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thanks again for tuning in. This week, I'm going to talk about the federal budget and how it affects housing. I've had some comments about the foreign buyer ban, how they changed some of the restrictions on it, and also a couple of other things that I want to touch on in that. I will have some statistics. I'm not going across Canada this week. I'm going to save it for next week because I'm still waiting on boards to release their data and whatnot. So first off is the lifting of some restrictions on the foreign buyer ban. I just wanted to touch on this to see, what exactly it is and how it may affect the market. Amendments to the prohibition on the purchase of residential property by non-Canadians acts accompanying regulations. Wow, that's a mouthful. Let's see what convoluted scheme this is here. Today, the Honorable Ahmed Hussein, Minister of Housing, Diversity, and Inclusion, announced amendments to the prohibition of the purchase of residential property of non-Canadians Act accompanying regulations. So I want to start off with first looking at this guy's name, or his title, I should say. It is the Minister of Housing, Diversity, and Inclusion. And I think that most of you could agree that housing is the most non-inclusive or exclusive thing right now in Canada. And it's funny that, this guy's has that in the title. It seems like they've just kind of added a few things to his title to kind of satisfy certain Canadians or certain groups of people, I should say. So change number one, enable more work permit holders to purchase a home to live in while working in Canada. Okay, it makes sense, I guess. If you want to work here, I guess they're non-permanent residents by the looks of it. You can buy a house. I don't know why you'd want to buy a house in this overpriced market and speculate that especially when it's on a downtrend. But okay, not going to have much impact in my opinion, but let's see what else they have. Repealing existing provision to the prohibition doesn't apply to vacant land. So foreigners can still speculate on vacant land. Exception for development purposes, and also increasing the corporation foreign control threshold from 3% to 10%. So, of course, developers and foreign investors couldn't invest or develop new housing for Canadians, even if they weren't speculating, just for new homes and affordable homes, potentially, because of that threshold. So hopefully that's a positive, but I don't know. Once the government gets involved in any of these kinds of housing control measures, it doesn't work out well. And I wanted to bring you to an example of 2016 when they introduced the stress test. And I don't know who remembers, but initially they introduced the stress test for all insured mortgages. So if you were 20% or less down payment on a house and your mortgage needed to be insured as per Canada's rules, you were subject to a stress test. Meanwhile, any investors that had 20% or more down didn't have to do the stress test. They quickly realized by 2018, actually by 2017, but they implemented January 1st, 2018. The stress test now applied to everyone because first-time buyers and young families or people with less than 20% down were getting excluded from the market. Again, it goes to show you the inclusion minister there, where they were excluding people. So they had to redo it, and it affected everyone at that point. But the damage was done. They had over a year of people being shut out, and these were mostly end users getting shut out of the market, by the way. So again, they messed with the market then. They think they can mess with it now and fix things. They usually only make things worse with unintended consequences. And they don't know how the foreign buyer ban will work. And of course, they implemented it, and now they've changed it just months later. And I think that going forward, we're going to see that it really didn't have that much effect. And they might claim it did because the market was slowing anyway. But let's move on to the next topic on the budget. A code of conduct to protect Canadians with existing mortgages. So the next housing thing the government wanted to tackle was helping Canadians through this high interest period when they started with variable rate loans at low interest rates. Of course, they're going to come to renew, and they're going to have high interest periods to go through now. And banks a lot of times will charge penalties and service fees. So they're trying to eliminate that. But I just want to read a few lines from this, and it is just smoke and mirrors, and I'll explain why in a minute. Elevated interest rates have made it harder for some Canadians to make their mortgage payments, particularly those with variable rate mortgages. Canadians have the right to work with their mortgage lender to explore mortgage relief options that will help them stay in their home. So instead of losing their home to the bank because they can't pay it, the banks now have options. A lot of these options were available prior to this. And I just want to read the next wording and you'll kind of see what I mean. Specifically, the government is taking steps to protect Canadians and ensure that federally regulated financial institutions provide Canadians with a fair and equitable access to relief measures that are appropriate for the circumstances they are facing, including by extending amortizations, adjusting payment schedules, or authorizing lump sum payments. So technically the bank can use a fair and equitable. That was one of the first things in that sentence there. So they're not jamming people when it comes to renewal and they can't afford the payment. So they'll have the option to obviously not charge them a bunch of fees and extend their amortization or make lump sum payments. But all those things were available, as you'll see in the next line. It was very clear. So it's more about this regulation or this thing in the budget, which is still yet to be seen. By the way, the details aren't in yet. We kind of make the rules in Canada, then come up with the details later. But you can see here in this last line, we already have them. Existing mortgage regulations may also allow lenders to provide a temporary mortgage amortization extension, even past 25 years. So, of course, it's very clear that there's existing measures in place. But again, this kind of drills down to not getting screwed over by the banks with jamming people with fees and whatnot. And then you'll see on the last paragraph here, this guideline will ensure that Canadians are treated fairly and have equitable access to relief without facing unnecessary penalties, internal bank fees, or interest charges, which will help more Canadians afford the impact of elevated interest rates. So it seems that, this is a big help for Canadians. And again, I'd say this is smoke and mirrors. It's actually going to benefit the lenders. The lenders don't want to take your house. The lenders want, and the mortgage companies and the banks, they want you keeping your house and paying the mortgage and paying them interest. So let's look at how things will change if we're going to change some of these amortizations, which has already happened when you have these trigger rates. So what they're doing obviously is adding on interest and adding on years to your mortgage and keeping your rate or your payment the same right now with those fixed payment variable rate mortgages, which is a reasonably new product that, again, it benefits the bank. It keeps them collecting the interest. When you can't afford higher payments, you can keep your same payment and just pay them more interest. Let's look at a couple of scenarios here to see how that looks. And you'll see that it is in the best interest of the banks to do this. So here's an existing $500,000 variable rate mortgage with a 25-year amortization. And you can see it's just under $2,000 a month. And for the whole term, for the 25 years, or I should say for the whole amortization, you're going to pay $500,000 off the mortgage, and your interest is just under $100,000. Now, when you compare that with the same mortgage, but when people come to renew and they get their amortization there, you can see at the bottom, they get it extended to 35 years to keep their payment within reason. It's only $350 more than it was with the variable rate. And of course, this is going to be a fixed rate at 4.5%. Now you're paying off $500,000 in principal over the 35 years, but now you have almost $500,000 in interest. So you can see who the beneficiary is here. You get to stay in your house, but the bank collects $400,000 more interest from you. Now that was, of course, that was just for the whole term or for the whole amortization. Let's look at just the 5-year term, because you can say, well, interest rates might go down when you go to renew again in 5 years. So let's look at that on more of a reasonable scale. And here's the first scenario again here. So everything's the same as before, $500,000 mortgage, 1.5% variable rate at 25-year amortization. And you can see the principal paid in the first 5 years, it's a 5-year term, was $34,000, and the principal paid was $85,000. So you're paying a good chunk off your mortgage, and your interest is reasonable. And comparing that now, if the bank decides to extend your amortization to keep your payment reasonable, it's an extra $350 a month in your mortgage payment, which is significant. Same mortgage, 4.5% on a 5-year fixed. So in that 5-year term, you almost flip. You're actually paying more interest than you paid principal before. You're paying $107,000 in interest, and you're only paying off $33,000 in your mortgage. So while it looks like, the government and the banks are here to help Canadians through this tough time, they're actually not getting any further ahead. They'd probably be better off renting, because they're really paying off no interest once they renew on their mortgage. So again, smoke and mirrors, and it really isn't helping Canadians at all. It actually is helping the banks and their shareholders. So I want to look at a chart of house prices and the sales in certain price ranges in the 20 boards surrounding GTA in Ontario. And you can see this one is from the Q1, the first 3 months of 2022. And the highest selling price point or the most sales was in that 1 million to 1.25 million price range. You can see, and of course, next after that is the 800 to 900 and so on. But I've noticed when I'm doing evaluations for people and I'm like looking for homes in their price range, and when they're over a million, especially in my area, I can never find any sales. They're always under a million. And I know it's because the market has changed, but it led me to say, okay, how much under are they, or how have things shifted? So what I've done is by price range, I've calculated, or I've done another chart here to show you how the sales have dropped off by price range. And it's pretty interesting to look at. This is the same area, but this is Q1 of 2023 now. And I'll leave them up here side by side so you can look at them both. Now, the most prevalent price range, or the most sales in that price range from last year, was that 1 million to 1.25 million. And you can see their sales have dropped off by 70%, which is huge. And then going over that to the next price block is 73% decline, 1.5 to 1.75 million. They've lost 73% of their sales. And you can see all the way to the $600,000 to $700,000 price point, you're losing sales or market share of the sales. It's now down 8% from Q1 last year. It's not until you get to the $500,000 to $600,000 price range that the sales increase over last year. And again, just as interesting on the downside or on the lower price points, have plus 18% over last year on the 500,000 to 600,000. Almost 50% increase in sales in the $400,000 to $500,000 price range, 90% more sales in the $350,000 to $400,000 price range, and of course 60% and down from that. So you can clearly see that the price points are clearly shifting downwards. So anyone that says there's sales and there's prices going up, they've clearly shifted from a higher price point over a million to well below. And it was pretty interesting to look at this chart to see which price points are actually doing the best right now. Okay, so I had two areas that were requested that I could remember. I know that people request. I try to get to them. It's hard to kind of pick certain areas. These are in my data zone, or in the data I have access to. First one is going to be Kingston. Someone had asked, hey, how's the Kingston market? This is the up until March this year. You can see March was actually down in Kingston area. Not a whole lot of data there. I think there was 150 something sales for March, and they were down 5.5% month over month from February to March this year, or $34,000. Down 18.6% year over year from March 2022 to this March, or $134,000. And they're down 20.5% from the February peak, or $151,000. And looking at the new listings in Kingston, they are increasing into the spring as expected. Sales, of course, are increasing also coming into the spring, still at a very low level for March, though. Days on market is dropping as we get into the spring. Of course, it takes less time to sell your house. And the months of supply has increased. They're at about 2.2 right now in that area. And this is just for the city of Kingston. It's not the Kingston area. You can see clearly that the months of supply is now at pre-pandemic levels in that area. And the next and last area that was requested was Burlington. Again, this is just the city of Burlington. It doesn't include any of the outlying areas. Burlington also had a month-over-month loss. They were down 2.3% from February to March this year, or $25,000. 19.5% year over year from March last year to this year, $254,000. And down 24.6% from the February peak last year, and that's $341,000 decline. Pretty significant dollar decline there. And just like everywhere else, new listings are increasing in Burlington coming into the spring. Sales are also increasing just like listings, but both are still relatively low levels. Average days on market is coming down, and the months of supply is 2.7 months and is well into pre-pandemic levels. I should have went back with 5 years on this one. I don't know why it turned out to 3, but you can see it's clearly higher than any point throughout the last 3 years. So next week, I'm going to go right across the country to check all the major places like I normally do. Until then, I'll see you next time.